In the last week, the majority of companies have been performing fairly strongly, but there are also some industries that don't share that same momentum. We're seeing them down, and that is the focus in today's episode. We want to look at companies, we're talking in the hundreds of billions, that have been hit hard, that look ready for a massive rebound. And these are ones that have got no attention when investor sentiment is sitting at greed. We can already see, because valuations are becoming more and more stretched, that opportunities are becoming even thinner. And kicking off, we have Salesforce as stock number one, which is down 31% year to date. We're talking about a company that now is sitting pretty much at a 52-week low, yet if you were a longer term shareholder, you would still be outperforming the S&P. And nice to note, both Seeking Alpha and Wall Street have given this a buy rating. Wall Street not far off the 4.5 to flip it into a strong buy. And it also looks incredibly attractive when you look at many different metrics. We've looked at one that isn't used that often, the EV to the free cash flow, where it's trading, we're talking at a decade low below 18. And whilst we're still waiting for their latest earnings due to be reported this month, the previous one we got a double beat, and they're also showing they can still grow their top line. Most recent quarter it was up 8%. And to make matters even better in identifying undervalued opportunities, they also raised their full year outlook, and they're now trading at a forward PE below 20. That is severe undervaluation when you consider historically it's been at 31. And you're also getting a yield 0.7% above historical 0.6. And if we were to look at the blue tunnel methodology, which highlights the intrinsic fair value, again, undervaluation, share price shows disparity between the bottom end, pretty much going lower and lower, whilst the intrinsic price, at least in the last few months, has in fact stayed flat. But worth noting, this company over the longer term has been trading in an undervalued area, which just highlights the market for now does seem to be mispricing that, which could give rise to an extremely strong opportunity. And they're also forecasted to continue growth over the next 4 quarters, 3 of them double digit, with a 75% track record. 3 out of 4 beats, last 2 great to see. And if we look at their growth, while they do get a C, they're expected to grow pretty much in line with last year, around the 8 to 9% point. That is above the sector, but one thing that does weigh down on this company, and that is something to consider, the growth story is slowing down. Yet, having said that, earnings per share, they're expecting 18% growth year on year over the next 3 to 5, well above the sector median, but also not too far off their own historical. And this is also one institutions like with their 80% ownership. Yes, they've sold 26 billion in the last year. They bought a lot more at 37 billion, and we can also see the continuation of institutions being net buyers. In Q2, they've bought more than they have in fact sold. Something we've seen for quite some time. If you wanted the reversal, you'd have to go to Q3 2023. And whilst we're still waiting for all super investors to disclose their updated position, 8 of them currently hold Salesforce in their portfolio. We also see one super investor adding more to their portfolio, 845,000 shares. Granted, it is a small percentage of their overall portfolio. This is something though we see from many super investors. They hold quite a number of companies. And our own intrinsic value at $371 derived from the DCF model, we're using an 8% growth rate moving forward. We have to bring to your attention that only 1.4% growth is baked in currently based on a reverse DCF model. So if you believe growth rate should be 4, a lot lower than what we've used, you're still looking at upside. Remember, we have the growth rate at 8%. Just look at the last few years. We're talking strong double digit. So we do believe this to be extremely conservative. And with the discount rate, as always, giving us the present value of future free cash flow, which we add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, 371, indicating 59% upside. Now, if you believe that to be appropriate, well, already you're looking at a 37.2% margin of safety. If you want even more for whatever reason, at 40%, a buy at $222. So really highlighting incredible opportunity. Wall Street themselves see this at 355 into 2026. That is upside of 52%. Now, you may be there saying you want to be even more conservative. You're unsure about the future with artificial intelligence, so you want to use the 4%, which comes to 280, indicating 20% upside. Well, that is already baked in 17% in terms of the margin of safety. If you want 20, well, a buy at 224. If you want 25, 210. So at the lower end, you're still getting a very attractive MOS given the conservative estimates. Wall Street, very bullish. Stock number 1, Salesforce. Let us know if you see it as a buy, hold, or avoid. Before we continue, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Fortinet, down 17% year to date, although over the last year still positive, up 12. Over the last 10, significant outperformance, up 815%. They're also trading near their 52-week lows, and we just get one buy rating from Seeking Alpha. Worth highlighting though, the forward valuation sits below 30, something we haven't seen in quite some time. And this company continues to produce more and more revenue over the years. Alongside that, the bottom line net income continues to climb. In fact, whilst revenue from 2020 has been increasing 22% year on year, the bottom line net income has been moving at a faster rate, 36%, showing us we are seeing some real improvement in their margins, in their efficiencies, and that also expands when we look at their capital allocation, ROIC, ROE, ROC, ROA, all of these that highlight their efficiencies are moving in the right direction. However, they are only expecting 3 of the next 4 quarters to be growth to the EPS, 100% track record, and based on their next full accounting period, trading at a forward P around 28.1. Now, whilst growth comes in at a D+, year-on-year revenue 15%, this year expected 13%, well above the sector median, but similar case to Salesforce, they are growing slower than they have done on a historical basis. EPS not too bad at 14, pretty much in line with the sector, but a little bit below their 5-year at 17. And institutions with 84% ownership selling 5.7 billion, they've been buying a lot more at 9 billion. They continue to do so in the most recent quarter, where they bought twice as much as they did sell. If you wanted the reversal, you'd have to go by quite some distance to Q4 2023. Now, our intrinsic value, $118, using a 15% growth rate moving forwards. Highlighting here, 9.1% is baked in. Even if you believe it should be low at 10%, you can see upside, although marginally. If you're at the other end of the spectrum, 20% growth rate, 108%. And as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Fortinet, or anything else. So 15% baked in 9.1, you're currently getting a 33% margin of safety. If you want more at 40% again, we can see $71, which is where it did hit at the low point after their earnings release. And Wall Street, well, they see 42% upside, $112 price target. Now look, we'll go one step further for those that believe it should be 10%. They believe growth rate will start to decrease. Bearing in mind, average sits at 26. You're getting a margin of safety, but to a much lower degree at 6%. For those that want 20, a buy at 67, and at 25, $63. Fortinet, stock number 2, let us know your thoughts. We then move on to Marvel Technology, down 30% year to date over the last 10. Another massive outperform of the S&P, trading towards the lower end of the 52-week range. Not only a double buy from Seeking Alpha and Wall Street, Wall Street 4.48, very close to 4.5 to a strong buy, so obvious to see where they sit. With a forward valuation 26, well below historical 35, another severe undervaluation, at least for further consideration. Yield not too dissimilar from their historical, and we can see here, nice in fact to note, the blue tunnel moving in the upwards trajectory, the share price moving the other way, which always signals opportunity, and that is what we can also note, disparity between current value and the bottom end. Something that when we zoom out to the last 5 years, we can see there have been times where it's been overpriced, times where it's been underpriced, but ultimately this one right now showing disparity, potential opportunity. Also phenomenal in terms of their expectations. Out of the next 4, in fact Q2 when they're going to report triple digit growth expected, the subsequent 3 double digit, 100% track record, trading on Jan 2027 at a forward PE below 22, and growth also impressive with an A-, 22% year on year expected this year. Not only are we seeing this above the sector, but unlike the previous 2, they're growing at a faster rate than their own historical. EPS, very impressive if they can hit the 36% projected, again, better than both comparatives. Institutions with their 84% ownership selling 11 billion, buying a bit more at 13.5, bought a lot more than double in the most recent quarter, and if you want the reverse of the trend, Q1 2024. Overall, Marvel Tech though, institutions are net buyers, where our intrinsic value at $102 is derived using a growth rate of 15%. Baked in is 11, so actually this one, if you use the lower rate, we actually note downside of 5%. Using 15%, a margin of safety of 23.5%. If you wanted 30, that would be a buy around $71. If you wanted 40, sitting somewhere around the $61 mark. Wall Street themselves, they see $94 into next year, 21% upside. And for those that want to see at the 10%, yes, instead of now sitting on a margin of safety, given the negative 6%, this tells us there is a premium of 6%. Margin of safety though, if you did want it at 20%, a buy at 59, at 25.55. Marvel Tech, give us your views. The next one we're moving on to is United Health, down 48% year to date, over the last year losing more than one half of their market cap, and over the last 10 years now, with the drop, they've just marginally underperformed the S&P, trading very close to a 52-week low, huge pullback from 52-week high above $630, with a double buy from both Seeking Alpha as well as Wall Street. And we should make it clear now, this is the most bought stock by super investors in Q2, and it has been the likes of Google, Taiwan Semiconductors, TMO, and Meta Platforms, with 6 individuals adding to their portfolio. And if we look at it in terms of the percentage increase to their portfolio, still sitting very high in second place. Now we still get the undervaluation signal, 16 forward P versus 20, yield well above 3%, historical at 1.4, and we can highlight the dividend given the disparity does look to be safe at an 80 score, with the blue tunnel also just about highlighting undervaluation. Now we can see it has been decreasing recently due to the issues surrounding the earnings per share being lowered. In fact, guidance was initially cut and then suspended. And if we zoom out to the last 5 years, the clearer picture can show fairly high quality company up until 2025. Doesn't mean it isn't anymore, but we can see currently the company is going through a fairly tough period, and they only expect one of the next 4 quarters to be growth. 50% track record, with the most recent 2 quarters they did miss, trading if in fact they do hit this earnings per share, which is based on analyst assumptions, lowering the forward PE to 13.7. Now growth seeing an F, yes we do notice year on year revenue 10% and forward looking at 8, not that bad. We're talking pretty much in line or thereabouts with the sector as well as their own 5-year. However, the real kicker here is earnings per share expected no growth in the next 3 to 5 years. The 2 comparatives here highlighting 10 and 13% respectively. Institutions with their 88% ownership in the last year, they've been net buyers, 41 billion selling, 56 billion buying, but actually in Q2 we see the opposite, a lot more selling at 7 billion versus 4 billion buys. Now this valuation is a bit of a messy one, so the first thing we'll start off with is the DCF model, just highlighting that baked into their free cash flow year on year is a decrease of 3.7%. Purely on that alone, if you like this model, you could say undervaluation. And then we move on to the 2 values. First intrinsic value is the average of the 4 that you see on screen. This one, in fact, is for those that believe the problem surrounding the company is for the longer term, and that ultimately gives a 9.3% margin of safety. Wall Street themselves see this at 325 in the next year. They have continued to lower their price target, seeing 22% upside. If you wanted a more MOS at this level, 20%, a buy at 235, and at 25, around 220. The second model here, for those that believe the issues are isolated, the company will pick back up over the next year or two. We're using the DCF and the DDM, $443, 40% margin of safety baked in. Let us know, UNH, where you see this company, and if in your own portfolio it's a buy, hold, or complete avoid. We then move to Accenture, down 32% year to date. Over the last 10, marginally outperforming the S&P. We can also see it now trading like a few today at its 52-week low, with a double buy from seeking alpha in Wall Street. We'll get an undervaluation forward PE of 18, that is well below the 27.2, and in fact the lowest in the last 5 years, whilst also a yield of 2.5%, significantly above the 5-year 1.5, with unsurprisingly a severe undervaluation signal, something only noted for around April this year. Otherwise, for a large part, it wasn't the reasonable signal. And in fact, over the last 5 years, this just highlights Accenture is one that incredibly rare to see in an undervaluation point. Now, first things first, green right across the board, love to see, with estimated over the next 4 quarters around mid-single digit growth to earnings per share, trading on August 26, forward valuation of 17.2. But growth is the one thing that fairly lacks. We're talking year-on-year 6%, this year expected 5%, lower in fact, as we can see, than the sector as well as their own historical. Earnings per share not looking too great, around 7 to 8%. Sector quite high at 15, and their 5-year average still higher at 10.2. Now, what are the institutions doing with their 75% ownership? They sold $13 billion. They bought a lot more in the same period. In fact, we're talking twice as much. They've bought around triple as much in Q2. This one actually very clear and obvious to see. Institutions have been very bullish, net buyers every single quarter going back to 2022. In our intrinsic value of highlights, the growth rate we've used at the lower end of 6%, 6, 8, and 10 all giving some very strong upside. Baked in is only 1.3% to the DCF, and we notice out of the last 10 years, there was only 1 year where it came below that, and that was in the most recent one where it did dip -4. So using 6%, which as we said is the lower rate today, you are already getting a 29% MOS. If you wanted more at 35, a buy at 218. If you wanted 40, we can see $201. Wall Street, $330 into next year, 39% upside, very bullish on Accenture. Give us your thoughts. Is this one to seriously consider? We then move on to Adobe. Like Salesforce, this industry has been hit hard. They're down 24% year to date. Over the last year, even further, -36. Yet over the last 10 years, they've still managed to outperform, up 330%. Trading again, another company at a 52-week low with a double buy from seeking alpha in Wall Street. Forward valuation just above 16. And even if we look at the EV to EBIT, again, another model, we're talking at a 10-year low, 17.6. All whilst we're seeing valuations lower year after year, going back to 2015. Yet, what are we seeing happen with the bottom line net income? It is moving upwards in the right trajectory. So this is another one that looks to continually be mispriced by the market, where they're expecting double-digit growth over the next 4 quarters, 100% track record, trading on next full accounting period at a forward PE below 15. And their growth, it does come in at C-, but we're talking 11% last year, 10% this year. A lot better than the sector, although similar to others like Salesforce, growing slower than their historicals. Earnings per share also fairly respectable, 15 to 16, pretty much in line with both sector and their own 5-year. And institutions with their 82% ownership selling $20 billion, they've been buying more at 26, buying more again in Q2. So this is one that could be a great opportunity, where our intrinsic value of $519 using an 8% growth rate is highlighting only 2.1% is baked in right now. And again, if we look at the last 10 years, there was only 1 year where we got to see lower. That was in 2023. So 8% growth, we're talking 54%. There's still upside if you want to go even lower at 4%. And if you believe it should be 12, which is still below the average, you're talking more than a double. Now, using the middle of 8%, 35% margin of safety baked in. If you wanted even more at 40, 312. Wall Street see this 482 into next year, 43% upside. So let us know your thoughts on Adobe. We'll also just flag by using a 4% growth rate what the margin of safety is. Still very respectable, just over 13. If you wanted 20, a buy at 311, and if you wanted 30 at 272. So Adobe, give us your thoughts. Wall Street clearly very bullish with their upside like the rest of the companies today. Buy, hold, or avoid. Don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.